Greetings everyone, Scott Richardson, Dan Brown from Richardson Capital Management here to present the January 2023 Economic and Investment Update. Well, the good news is the financial markets performed much better in the month of January than they did in 2022, as both stocks and bonds were up during the month. There were a number of factors that caused that, and with that, I'm going to turn it over to Dan to give us a quick update on what did happen in January.
Thanks, Scott. So the main catalyst for stocks moving higher and reversing the losses from December was primarily the fact that the inflation metrics that we monitor all continue to trend lower in the month of January. So investors were encouraged by that and pushed stocks higher. What this meant for the stock market is that a lot of investors are thinking, well, the Federal Reserve could end their interest rate hiking campaign earlier than expected. We're thinking maybe that ends sometime here in the first quarter of 2023. So that was the main catalyst for pushing stocks higher. And if we examine the returns a little bit further in detail, we see that international stocks and emerging market stocks were two leadership groups. International stocks mainly because, namely Europe, has avoided a recession up to this point, and a lot of investors were expecting that Europe would be in a recession due to the Ukraine-Russia war and the shortage of energy supplies. But they've dodged that for the most part up to this point. And then on the emerging market front, after a couple of years of zero COVID in China, they have pulled back on that policy and they began to open their economy, and economic growth is moving higher here in the month of January. So Scott, we've got a Federal Reserve meeting coming up on February 1st. Do you want to share a little bit more about what we're expecting from the Fed and what we're going to hear from them?
Sure. So as Dan mentioned, one of the key things that the financial markets are looking at is what's the policy going forward with regard to interest rates. And with inflation retracting a bit during the month of January, a lot of the market participants are thinking that the Fed is going to slow, if not stop, their interest rate increases, and at some point later in the year start decreasing those interest rates. Now, what we found interesting was during the month of January, the Fed was pretty consistent in their messaging to the investor community that they are going to continue to raise rates at least for a couple more sessions here. So we've got the upcoming meeting on February 1st, and we're anticipating they're going to increase rates 0.25%. And we're also anticipating that probably in that following meeting, they're going to increase them another 0.25%. However, at that point, we think they're probably going to hold steady. But the key question is, are they going to keep rates at that level, or are they going to start decreasing those rates at some point in the not too distant future? There's a little bit of a disconnect there, as the financial markets, I think, are hoping or anticipating that they're going to start decreasing those rates sooner than later. The Fed's made it sound like, hey, we're going to be a little bit more cautious on this and it might take a little bit more time. So obviously we're going to need to keep a careful eye on that, as that's going to impact the financial markets going forward here. So Dan, let's shift gears here and kind of replay last year again, because it was a historically bad year, and we've got some context that I think you can share with the viewers here.
Sure, Scott. So we put together a scatter plot here looking at the returns for both stocks and bonds for about the last 145 years. And our takeaway from this graph is that last year was one of the worst years for the financial markets ever. And what it shows is that both stocks and bonds were down double-digit negative, and we've never seen that before. So hoping that 2023 is going to be a better year, and we would expect that fixed income bonds are going to return to their normal traditional role of acting as a buffer within the portfolios, mainly because, as you just talked to, we think the Federal Reserve is nearing the end of its interest rate campaign, and we're not expecting interest rates to increase as much as they did this year as they did last year. So Scott, do you want to share an outlook with our viewers?
We came off of a historically bad year last year. January is off to a much better start. We think that the markets are going to remain volatile for the first, certainly half of the year. I think we're of the opinion that there's a decent likelihood we're going to have a recession, but we think it's probably going to be shallow and relatively short. And we think that we're going to have some opportunities toward the back half of the year to start redeploying some of our more conservatively invested assets a little bit more aggressively to try to start recouping some of the losses that were incurred last year and feeling better about the prospects going forward now that the Fed is hopefully stop raising the interest rates and we'll get some more stability in the financial markets. So with that, I want to thank everyone for joining us and watching this video. If you found the information useful, please click on the like and subscribe buttons, and certainly don't hesitate to share this with any family or friends that you think could benefit from it. And again, thanks for the continued support.